Hello, folks. Brandon Chapman with you today. It's another Monday video for Theo Night. I just want to, for October, what is it? November 14th, 2022. The curious case of a rising market as bulls have pushed prices at least intraday to a 2-month high, only to see them fade. The question is, with declining margins and falling revenues year over year, how is the market going to stage new highs, and when are we going to get there? When is this curious case of shrinking margins, shrinking revenues, and a rising market going to be resolved? We'll look at some volatility gauges that may suggest we're not quite there yet, as well as some sector funds and other areas of the market as well. All right, let's get rolling here. So as we look at the ES, you'll see intraday, we did test the highest level, just edging out Friday's high that we've seen since the 13th of September. And, again, it's interesting that we're able to see these kinds of moves, but later in the session, we saw things begin to turn as we look at an intraday chart, and we began to give back some of those modest gains that we established throughout the course of the trading day. And of course, a little bit of overnight gap from Friday rallied and then fizzled towards the end. And again, is there any news to necessarily attribute to that? No, not necessarily. It's natural that you see prices kind of ebb and flow up and down. Obviously, the news from FTX has been a big deal for the markets, particularly back on that news /BTC. A rather large gap down, a large drop last week, only to kind of bounce back on Thursday, and we're kind of whittling lower towards the lows on the 9th. But the reality is FTX has nothing to do with Bitcoin. A centralized exchange for decentralized markets doesn't make sense, does it? So really we're showing the issues are centralization of markets rather than decentralized markets. And that continues to be the problem with news you hear of issues having to do with storing your money with a bank for your coins or tokens with a bank, etc. And so again, but it is affecting things. The dollar has been weakening. As we look at the dollar index, the dollar's dropped rather precipitously since the 3rd of November. And that's kind of keying off from some of the inflation data we got that was a little bit lower than what was expected, but still high year over year. And there's this kind of reshaping of expectations for the Federal Reserve that maybe, just maybe, they may raise the bar in terms of what might be deemed acceptable from an inflation perspective. And again, if they raise that again, does that mean we're going to lessen the rate of increases we're seeing? Is December going to be kind of that last kind of high note, and we may moderate from there? There's been some expectation of that. Certainly, Fed Brainerd, Lael Brainerd, what is it? President, regional president, whatever she is, kind of suggested that as well, as maybe, again, those pace of increases may moderate. As we think about this, again, does that really change the dynamics? All they're saying is that the market and the economy is weak enough that we probably don't want to raise rates, that the supply issues may not be, so the Fed rate increases may not be may not resolve supply problems. So we have all this stuff swirling around. Meanwhile, the market is testing a relatively high levels, 61% retracement. But the volatility markets, as we look at the VIX actually increased today a little bit. We're not really down around prior levels, closer to 20. And a better angle on this is taking the 3-month VIX to the 1-month VIX or the forward premium. This ratio actually declined today after reaching a level about 1.15. What that means is that the 3-month VIX was about 15% higher than the 1-month VIX last Friday. So we're not quite to that 1.2 level where the 3-month VIX is 20% higher. So again, suggests there may be a little bit more room to run, but maybe we do just get a little short breather here for a day or two before we start to melt higher again. A lot depends on what the dollar is going to do. As you look at the SKU index, this has not been updated for today yet, but we did see a little bit of a step up, but SKU is really low. What we're not seeing is hedges. As this rises, hedges are being put on, and 130 is kind of a key level. So this to me suggests there is some desire to want to be long the market still, that we're not seeing the worry come in or the hedging come in that suggests they're expecting a major decline. That doesn't mean that we can't see the market kind of whittle back here towards, let's say, 3,900 if we bring up /ES. back towards 3,900, maybe down here about 3,850. We'll see. There's certainly room for that to happen. That's the midpoint of the large candle from the 10th as an example here. But it does not change the dynamics of the fact that earnings are being crimped. So I read an article today, I think it was a Market Watch, but it kind of took 75 information technology companies within the S&P 500, added the FANGs in there, added some gaming companies, and it checked for a couple of things. Revenue increase year over year, gross margin increase, and operating margin increase. There was only 22 companies that were on that list after that point in time. And you think about revenue growth and margin growth as being key determinants of growth companies. And what's more growth oriented than the tech sector that actually declined about 0.86% today? And so this puts in perspective a little bit some of the issues that are occurring right now. We saw a lot of companies take on substantial debt in 2020. Right now, the high yield index is about 8.8%. That's borrowing costs, the highest since May when it was 2020, where it had reached a high point of 9.5%. And that's when the Federal Reserve came in and began to buy junk bonds, for example. Crazy stuff. The investment grade index, 5.7%, the highest since 2009. What's similar here? We saw a crisis in 2020. We saw a crisis in 2009. What's holding it up right now is not necessarily a crisis, but it's the Federal Reserve driving up interest rates that's driving these up. We've yet to experience the crisis. And what happens if they have to keep rates where they're at, and then we start to see some default issues come in, and we start to see risk spreads begin to widen? That's where things get really hairy for the markets. That's where we're not there yet, right? So the Curious Case, if you guys have seen that movie, Curious Case of Benjamin Button, he shrinks as he gets older, right? This is an old bull market, and we're seeing right now revenues, earnings, margins shrinking generally because of higher costs, not only of borrowing, but of inputs for production, labor, etc. So can the Fed continue to raise rates and drive interest rates higher? Again, you look at the drop here in the 10-year Treasury yield last week, suggests they're expecting the Fed to maybe starting to temper. But again, we're only doing that because there's real issues. Layoffs abound at this point, among other things. Today, we're going to look at a few kind of bearish setups that have occurred, like option activity. And again, I have a scan that I do, and again, I've kind of expanded it here because I run various iterations of this, so this kind of captures a lot of it anyway. But I'm going to go by symbol. Scroll up to the top. One stock that's seen some bearish activity come in is Apple. And you look here, for example, the 19 May 23 130 put, 26,000 contracts against 1,500 open interest. Let's take a look at Apple for the moment. Apple's had a phenomenal week. It had a very large couple of up days. We had some bearish option activity come in late last week. I believe on Friday, it was a 135 strike, which was down here. And again, we look at the scan today. We're seeing a 130 put for 19 May. Now, that's a little ways out. So we're not going to have kind of that gamma type effect near as much because the delta is more slow to move. But you're seeing some interest build in here. Again, in Apple, downside here about 130. And so we got 135 on Friday, 130 today. And what we're seeing is the downside's being kind of opened here. Why? I mean, if you look at the earnings outlook for Apple, it has not really been cut all that much. And yet we're kind of seeing the ripple effect of a lot of this policy and reducing of stimulus. We're starting to see, again, margins. We're seeing revenue growth begin to stall for many, many companies, not necessarily Apple. But when does that start to bite? So again, we've seen interest build at 135 and 130 today, just over the last couple of days. And so again, how can you treat something like this? Even something simple like an in-out spread, just going out like 30 days. If you're expecting a little short pullback, the vol skew is favorable, like a 155, 150, 150, 145, somewhere here. Again, all you need is the stock to decline below 145 by expiration. But if it drops a little bit further towards 140, you could close a spread like that out pretty quickly for about 30 to 55% gain. Let's look at another one here. Walmart. We'll get to XLP. Walmart. We had this little congestion phase here for a couple of weeks. I mean, Walmart's earnings, were they fantastic? Not exactly, right? They beat estimates, but there's been broader issues with Walmart, and they do have their earnings coming up before market tomorrow. And so this is a little late to the game to talk about it right now. I talked about it earlier during my session for our TheoTrade members. But again, do we see the breakdown? We saw the breakdown late in the session, but it was today in Walmart, 18 no of expiration here. It was a 138, 131. At the time, it was kind of a ratio there. You bought fewer 138s than you sold 131s. But you look at the market maker move here, about $8. That puts you close to 138. So puts you close to 130 down here. So we have this little kind of pre-earnings run, consolidation. If we disappoint tomorrow, we could very readily see this back at 130. So we'll see if it happens, just kind of gaps down there, or we open lower and trade down there. So one to watch tomorrow, depending on how we open up, because earnings are coming out before the market opens. And again, some of the bearish activity issues regarding margins, year-over-year inflation numbers are still running very high. And we could see that pressure being born, maybe not to the degree we saw back in May, but again, it certainly looks like we may close that earnings gap that we had from August. Something to watch out for. Of course, if Walmart goes down, that creates a drag on XLP. And XLP got very extended here a little bit over a couple of weeks ago. We talked about doing some like a bearish spread there, in-out spread. You had a chance to really kind of close that out within a couple of days, ratchet it back up again. We're slightly higher than that high. But today with Walmart, some of that data. We also saw today, again, go back to scan. We'll scroll down to XLP. And I guess here's your Walmart. But anyway, so again, this is something I take in chunks throughout the day because it's a lot to bite off at the end. But XLP, you see that 18 of 73 put for XLP. So again, 73 is just a little bit lower than we're currently, or it's basically at the money. But again, reflective of bearish expectations for XLP. So again, we're not really stretching here trying to out the money, but again, watch if we start to break 73, you could start to see that gamma squeeze start to push prices lower, looking near term, probably at about 70.5 down here on XLP, especially if Walmart helps it along. When you think about interest rates, and I mentioned where some of the rates were for junk bonds and investment grade bonds here, you think about also consumers, right? You know, we had a little bit of a sweet spot here for Synchrony and some other companies that are kind of credit card focused, consumers borrowing money for, Synchrony's in there. They're partnering with Amazon. What happens when defaults start to come around, right? Are the interest rates, do the layoffs eventually going to affect companies like this? And today we saw a pretty big turnaround in Synchrony Financial. Again, going back to the scan here, you'll see SYF, where are you? Right here. Synchrony Financial, it's 16Ds 37 put, 5,500 contracts. So we look at this 16 December expiration, and you'll see right here 5,500, 5,500. Now, 4,000 open interest. So you could kind of look at how that was being built. You'd actually see that these were spreads that were put on all together. So my guess, we're going to add to that about maybe upwards of 9,000 open interest here as we kind of end of day data, add the volume to the open interest here. That should upgrade to about 5,500. As you look down here, some chunks that were put on 37, 33. This is what's called a long put vertical. You're buying the 37, you're selling the 33. Expecting what? You need the stock below 33. $33 is right here. So again, we had a very, very nice couple of weeks. We got very, very extended up here. Don has his expected move indicator. That's what this is designed for, is to identify extremes. You'll notice on Friday, in fact, I think I have this set to 3 times the expected move right now. So as you go to edit studies, right click here, edit sources. I'm going to scroll down. This is a very complex formula or code that's in this thing. And I probably scrolled over it too quickly here. Here we go, right here. So I have it, set to 3 times the expected move. So think about this for a second. The market was pricing in about, last week about 36.50. We popped up and closed on Friday at nearly 40 and a half. This upper line here is 3 times the expected move coming the week. And so again, these can create good opportunities for trading bearish trades, expecting things to come in. Well, we're one day into it, into this move, 6% decline here. But again, today's trade indicates potentially maybe dropping to $33, which is down in here. So again, this trade may not be done yet, or this sell-off may not be done as we start to see things come around. And you could go to another consumer finance company like Capital One Financial, similarly closed 3 times the expected move on Friday, starting to come in today. Could we test 98, 100 down here? Absolutely. And these kinds of in-out spreads, while we're a day into it, probably not done. You look at 111.50 here. You could buy like a 115, sell a 110, and you're probably into it about 250. And again, that gives you about a 1-to-1 ratio of reward to risk. Close it for 30% of max gain if you get a move quickly in 3 days. Close it for 55% if it takes just a little bit longer. But again, what you're seeing today is you're seeing a bit of a turn in the expectations. And again, this is probably just near term. And when I say that, I just mean that the broader market is not exactly primed. When you look at the volatility indices, et cetera, it just doesn't look like it's yet primed for a major sell-off. But one thing about bear markets, you can be surprised, okay? So it doesn't always move as orderly, but the FTX news didn't seem to cause the market to stumble. But again, there could be another variable lurking in the shadows that could really create issues for the broader market if things turn. And one of those things is coming up tomorrow, for example. We have PPI. Well, we got CPI last week that led to the boost in the market. But what if, and that's kind of what's coming out the end of the pipe. What's in the pipe right now? Well, that's your PPI, Producer Price Index. Expectations are for 0.4% month over month, for a core number of 0.3%. Once you strip out food and energy, what if those numbers come in hotter than expected? So we're seeing right now inflation, moderate just slightly, still high on the CPI front. But what if the pipeline is heating up? So rather than trying to guess what's going to happen, that is a mover that could really affect things tomorrow if it comes in hotter than expected. If it comes in cooler than expected, we're probably reinforcing some of the move we got last week. And this may goose the market a little bit higher. So it does make sense. We took a little profits into the close today with PPI on the dock for tomorrow. But again, watch to see what happens. From my perspective, I'd love to see this get just a little bit more extreme, push those volatility measures a little bit over the line, and that creates that bearish setup like we saw back here on the 12th of August. I believe in our video on the 15th, I talked about those volatility indicators indicating what? A major 5 to 10% decline in the market. We're not signaling this right now. So if the PPI comes in cooler than expected, that may have a chance to push the market higher. Do we see some VIX selling? And do we start to see things reset? Because again, this curious case of shrinking revenues and earnings, that's not the curious case. The curious case is how the market is going to rally with that. And we'll see that will probably be resolved to the downside eventually. It's just right now we're trying to sort out what's the Fed going to do. The weaker dollars propping up gold, helping to hold up stock prices, at least for the time being. Eventually that support will be released. The dollar will strengthen. It's just a matter of when. But I think we may have a little bit of time left. Again, we've got PPI this week, core retail sales on Wednesday, a couple of big things coming up for this week. Anyway, we'll catch you back next week on the video. Have a great one.